Assalamualaikum and hi everyone. We are from Group 6 and we will be presenting about topic 2, which is the playing fields of foreign exchange and money market. This is our group member. First one is Nurul Ain binti Ainurizam 272559, Mohammad Aiman bin Jamalodin 272749, Nurul Fatin Najwa binti Rizal 273324, Nur Farisha Azura binti Mohammad Hanafi 275435, and lastly is Nur Faizah binti Mohammad 269727. Next, for our group social media link, we have two social media, which is Facebook and Instagram. For Facebook, it is named BWBB3073 Treasury Management Group 6, and as for Instagram, is at Treasury Management 6, and the link for the social media link is as above. As for our topic 2, we have 5 subtopics that we can achieve in this topic. For subtopic 1, we have who's who in the markets. Subtopic 2 is the interest rates and foreign exchange rates. Subtopic 3 is the interactions between the markets. Subtopic 4 is the factors affecting interest rates and FX rates movement. And last but not least is the subtopic 5, which is understanding market terminology. Alright, before we begin, let's get to know about what is foreign exchange market and money market. So, foreign exchange are known as Forex is the trading for one currency against another currency. So, for example, 1 ringgit can be swapped with $1. And how about money market? Money market is the trade in short-term loans between the banks and other financial institutions. So, there are 7 types of money market instruments that we can achieve. Firstly is money market funds. Secondly is money market accounts, certificates of deposits, commercial paper, bankers acceptance, Eurodollars, and lastly is repurchase agreement. Right now, I am going to pass on to the first presenter, which is Nurul Fatin Najwa.
Assalamualaikum, my name is Nur Fatin Najwa binti Rizal, metric number 273324. I will start with subtopic number 1, who's and who in the markets. Who's in the foreign exchange market? There are players. The first player is commercial and investment bank. The greatest volume of currency is traded in the interbank market. This is where banks of all sizes trade currency with each other and through electronic networks. Big banks account for a large percentage of total currency volume trades. Banks facilitate forex transactions for clients and conduct speculative trade from their own trading desks. When banks act as dealer for clients, the bid spread represent the bank's profit. Speculative currency trade are executed to profit on currency fluctuation. Currency can also provide diversification to a portfolio mix. Next, the second player is investment managers and hedge funds. Portfolio managers, pooled funds, hedge funds make up the second biggest collection of players in the forex market, next to banks and central banks. Investment managers trade currency for large accounts such as pension funds, foundations, and endowment. An investment manager with an international portfolio will have to purchase and sell currency to trade foreign currency. Investment manager may also make speculative forex trades, while some hedge funds execute speculative currency trades as part of their investment strategies. Next, the player is multinational companies. Firms engaged in importing and exporting conduct forex transactions to pay for goods and services. For example, of a German solar panel producer that imports American components and sells its finished product in China. After the final sale is made, the Chinese yuan the producer received must be converted back to euros. The German firm must then exchange euro for dollar to purchase more American components. Next, the player is individual investor. The volume of forex trades made by retail investor is extremely low compared to financial institutions and companies. However, it is growing rapidly in popularity. Retail investor-based currency trades on a combination of fundamentals, for example, interest rate, inflation rates, and monetary policy expectation, and technical factors such as support resistance, technical indicators, and price pattern. The last one of players is central banks. Open market operation and interest rate policies of central bank influence currency rates to a very large extent. A central bank is responsible for fixing the price of its native currency in forex. This is the exchange rate regime by which its currency will trade in the open market. Exchange rate regimes are divided into floating, fixed, and page types. Let's move to money market. Who in the money market? There are also players. The first one is commercial bank. Their purpose is to maintain liquidity and solvency, to use excess fund to get high profits, to borrow necessary funds at lowest cost. The second one is central bank. Their purpose is the desired level of money supply and the desired level of interest rates. Third one is other banking institution. Their purpose is they have the same objective like commercial bank earlier. They have liquidity position to mint and any excess fund need to be put in maximum use to get high returns. And then the fourth one is non-bank financial institution. The purpose is they have the same objective like commercial bank, and they have to focus to short-term borrowings and investments. Next is non-financial business. Their purpose is the buying and selling of instruments by writing a check or by actually acquiring and disposing of the relevant papers. And then the last one is individuals. The purpose is for transaction, for precautionary, and for speculation. For transaction is to make a payment and desired articles, and for precautionary in case some unforeseen event take place, and for speculation to gain profit from unexpected changes in rates of interest. That's all from me for subtopic 1, who's and who in the markets. Thank you. Let's move to another subtopic.
My name is Mohammad Aiman bin Jamalodin and my message number is 272749. Today I'm going to continue subtopic 2, which is interest rates and foreign exchange rates. What is interest rate? Interest rate is the rate amount charged on top of the principal by a lender to a borrower for the use of assets. Most mortgages use simple interest. However, some loans use compound interest, which is applied to principal but also to the accumulated interest of the previous period. A loan that is considered low risk by the lender will have a lower interest rate, while a loan that is considered high risk will have a higher interest rate. Consumer loans typically use an APR, which is annual percentage rate, which does not use compound interest. The APY, which is annual percentage yield, is the interest rate that is earned at a bank or credit union from saving account or certificate of deposit. Saving account and certificate deposit use compounded. Anything happen must have benefits. For the interest rate, the benefits of interest rate are more lending, stronger dollar helping us travel, same inflation, more interest for retirees, higher returns for savers. Last but not least, stock will trade on fundamentals. There are 6 types of interest. First, simple interest. Second, compound interest. Third, fixed interest. Fourth, variable interest. Fifth, amortized interest. Last but not least, discount rate interest. There are the latest base rate updated on August 2020. Airline banks was 2.57%, M-Bank 2.60%, CIMB Bank 2.75%, Citibank 2.40%, Hong Leong Bank 2.63%, HSBC 2.39%, Maybank 1.75%, OCBC Bank 2.58%, Public Bank 2.27%, RHB Bank 2.50%. Okay, continue. Standard Chartered 2.27%, UOB 2.61%, Bank Islam 2.52%, Bank Muamalat 2.56%, Bank Simpanan Nasional 2.60%, Agrobank 2.35%, RHB Easy 2.50%, Afin Bank 2.70%, Kuwait Finance House 2.25%, MBSB 2.65%, Al Rajhi Bank Malaysia 2.85%, Bank of China in Malaysia 2.55%. Okay, that's all for interest rate. Okay, what are foreign exchange rate? Exchange rate are determined in the foreign exchange market, which is open to wide range of buyers and sellers, where currency trading is continuous. In the retail currency exchange market, a different buying rate and selling rate will be quoted by money dealers. The foreign exchange rate is also regarded as the value of one country currency in terms of another currency. Okay, for foreign exchange, you must know trade. What is trade? Trade is a basic economic concept involving the buying and selling of goods and service, with compensation paid by a buyer to a seller, or the exchange of goods or service between parties. There are two types of trade, which are home or domestic trade. Second one, foreign and international trade. Under domestic trade, there are wholesale trade and retail trade, while under international trade, there are import trade, export trade, and interport trade. There are 6 benefits of trade. First, increased trade consumer choice. Second, new resources can be obtained for domestic industries. Third, economies of scale. Fourth, efficiency gained from specialization that can increase income and lower price. Fifth, foreign exchange can be earned to pay for imports. And last, reduce the power of domestic monopoly, which are lower price and more consumer choice. There are euro currency exchange rates by 16 April 2021. For 1 euro, they need 1.1986 US dollar to convert for 1 euro. 130.37 Japanese yen for 1 euro. 1.9558 Bulgarian lev for 1 euro. 25.927 Czech koruna for 1 euro. 7.4368 Danish krone for 1 euro. 0.86793 for pound sterling. 361.10 for Hungarian florin. 4.5509 for Polish zloty. 4.9263 for Romanian leu. 10.1055 for Swedish krona. 1.1011 for Swiss francs. 151.90 for Iceland krona. 10.0180 for Norwegian krone. 7.5668 for Croatia kuna. 90.8921 for Russian ruble. 9.6692 for Turkish lira. 1.5459 for Australia dollar. 6.7400 for Brazilian real. 1.4986 for Canadian dollar. 7.8157 for Chinese yuan renminbi. 9.3152 for Hong Kong dollar. 70,400 20 and 96 for Indonesia rupiah, 3.9286 Israel shekel, 89.2355 Indian rupee, 1335.70 South Korea won, 23.8806 Mexican peso, 4.9466 Malaysian ringgit, 1.6725 New Zealand dollar, 58.001 Philippine peso, 1.5980 Singapore dollar, 57.420 Thai baht, 17.0967 South Africa rand. That's all for foreign interest rate, and that's all for me. Thank you.
Assalamualaikum and hi everyone. My name is Nurul Ain binti Ainurizam, matrix number 272559, and I will be presenting about the third subtopic from topic 2, which is the interactions between the markets. Okay, as we know, we have a variety of types of markets, which is money markets, foreign exchange markets, bond markets, equity markets, and derivative markets. So firstly, what is money markets? Money markets is characterized by borrowing and lending a large amount of money and buying or selling money market instruments. So the community that were traded in the money market is money, or we can say new money, and the bulk of assets that traded in the money market have a maturity period of less than a year. Okay, next we got the foreign exchange market. Foreign exchange market is a global market of currency trading. This market also determines the rate of foreign exchange, which is the conversion rate of currency into another currency. So, foreign exchange rate is also regarded as the value of country currency in relation to another country's currency. Okay, the participants in this market can buy, sell, exchange, and speculate on the relative exchange rates of various currency pairs. So then, we have bond market. The bond market generally a debt market that pay instruments on for a fixed period of time. For loan periods, it is for 12 months up to 30 years. Bond market also can be called as fixed income markets. Bond market involves medium to long-term borrowing, such as 1 to 10 years instruments are called notes, and instruments that exceed 10 years are called bonds. Next, then we have equity markets. Equity market involves medium to long-term borrowing also, but in this case, interest is not paid to the lender. Borrowing institutions issue stocks or shares to investors who become part of the owners of the organization. So investors may or may not be paid dividends on their shares, depending on how well the organization performs. Okay, last but not least, I will explain about the derivative markets. Derivative markets refers to the financial market for financial instruments such as future contracts or options that are based on the values of their underlying assets. So there are 4 kinds of participants in a derivative market, such as hedgers, speculators, arbitrageurs, and margin traders. So furthermore, they ensure a ready market for the derivative financial tools and allows investors to hedge their risk and save themselves and their capital from uncharted or high swings. Next, I will be explaining about the interactions between markets into more details. So let's take a look. Firstly, I will explain about the money market. Money market will facilitate the transfer of short-term funds from agents with excess funds such as corporations, financial institutions, individual, or even government for those market participants that have lax funds for short-term needs. So they are instruments of the money market, which is treasury bills, call money, commercial paper, and commercial bills. Money market deals in short-term securities, and the maturity period of the securities under the market is 1 year or even less. Money market is very liquid. It trades in short-term financial assets that has low transaction costs, and the transactions are fast to withdraw. So, why bank needs money market? In long position, it will lend out to other banks in deficit position, and they will invest in financial statements. The bank will initiate the repo transaction, and the banks will buy the short-term market instruments. And as for the short position, the banks will borrow from other banks with surplus position. Then they will sell the stock of the liquid assets and they will initiate the reverse repo transaction. And the banks will seek Bank Negara Malaysia as lender of the last resort. Alright, now let's proceed with foreign exchange market. Foreign exchange market is a place where foreign monies are bought and sold. So, there are several foreign exchange market instruments that we need to recognize. That is bill of exchange, telegraphic transfer, bank draft, and letter of credit. Okay, foreign exchange market is used by the banks to transfer finance, purchasing power from one nation to another, which is telegraphic transfer. So they also provide credit for international trade that we call credit function. And last but not least is to make provision for hedging facilities. Alright then, let's take a look about the interactions in bond market, which we also can call fixed income market. Generally, in a bond market, the bond will be paid interest on instruments for a fixed period of the time, which is over 12 months to 30 years. So it is also involved with medium to long-term borrowing, and as for notes, 1 to 10 years instruments, and as for bonds, exceed 10 years instruments. So in the bond market, the bonds do not expire on their maturity, and it is also considered a long-term securities. There are primary markets for bonds. For example, the markets in which there are newly issued instruments are bought, and as for secondary markets, in which existing or second-hand instruments that are traded in the market. Let's move on to the equity market. The equity market is a key sector of financial markets where long-term financial instruments are traded. So, the purpose of equity instruments issued by the corporation is to raise funds for the firms. So, the equity market consists medium to long-term borrowing also, so which the interest is not paid to the lender. Moreover, the stocks or shares will be given to who become the owners of the organizations. So the investor may not be paid dividends, depends on the organizational performance itself. And last but not least, equity shares perform an institutional role as a means of ownership of the stocks. And last but not least for our subtopic, and I will be explaining about the derivative markets. Derivative markets can be summarized as where the investment is based on some underlying assets that are known as derivatives. So the capital is invested is less than the price of the underlying asset. That will be created financial leverage and allows the investors to multiply the rate of the return on the underlying asset. So, the uses of the derivative market is to speculate or taking an advantage of a specific profit opportunity. And other than that is to hedging a portfolio against a specific risk. So, the participants in the derivative markets own portfolios of financial securities for themselves. So, which it must be taken into consideration when you have to understand the impact of any particular derivative transaction that may be occurred. And that's all from me. Thank you.
Assalamualaikum, my name is Nur Faizah Azura binti Mohammad Hanafi, matric number 275435. I want to share about factors affecting interest rate and FX rate movement. First of all, let me share about interest rate movement factors. The first one is economy. In a growing economy, people have secure sources of earning and high confidence level to borrow and buy. For example, people go in for a house, car, and consumer appliance. This increases the demand for funds. It influences the rate of interest in upward direction. In a recessionary economic condition, the interest rate tend to go down due to the opposite happening. Second, inflation. The lenders prefer lending at interest rates that are higher than the rate of inflation. Otherwise, they will pose a negative growth in absolute terms. Therefore, a rise in the rate of inflation signals a higher interest rate regime. On the other hand, a drop in the rate of inflation indicates a softer interest rate regime. Next, stock market condition. Bullish stock market development encourage business to expand their equity holdings. Borrowing demand is reduced as a result of this. A weak stock market encourages corporations to borrow, increasing the need for funds. And the last one is international borrowing. The global economic condition influence the lending pattern of foreign investors to domestic companies and compete with domestic sources of fund in the market. Next, what is the factors of FX rate movement? First, inflation rate. A country with a consistently lower inflation rate see its currency appreciate, while a country with highest inflation see its currency depreciate, which is also followed by higher interest rate. Second, interest rate. Interest rate increase cause a country's currency to appreciate because higher interest rate offer higher rate to lender, attracting more international capital and causing exchange rate to rise. The third one is country current account. This account reflect balance of trade and earning on foreign investment. It consists of total number of transactions. Balance of payment in country can cause fluctuation in exchange rate of its domestic currency. Next, political stability and performance. An increase in foreign investment contributes to a rise in the value of the country's currency. A country with sound financial and trade policy does not give any room for uncertainty in value of its currency, but a country prone to political confusion may see depreciation in exchange rates. Next, term of trade. If a country's export price increase more than its import price, its term of trade improve. This lead to increased sale, which lead to increased demand for the country's currency and a rise in its value. And last but not least, government debt. Foreign investor will sell their bond in the open market if the market predict government debt within a certain country. As a result, a decrease in the value of its exchange rate will follow.
Assalamualaikum and good morning. My name is Nur Faizah binti Mohammad with metric number 269727. Today I will talk about market terminologies. Stock market terminologies are industry-specific terms which are frequently used when we read or talk about the stock market. Experts and novices often use these terms to talk about strategies and stock market charts, indices, and other elements of the stock market. There are 10 important things to know about stock market terminologies. The first one is index. An index is a benchmark measuring the performance of the stock market in a particular country. Each country has its own index and some have more than one. The second one is trading hours. Unlike the Forex market, the stock market is not open 24 hours as its schedules of trading. Most stock markets are open 9 a.m. to 5 p.m. in their time. It is usually based on their office hours. The third one is bought lot. The bought lot is the minimum number of shares one can purchase or sell a stock at a specific price range. This is usually provided by stockbrokers, so make sure to check on their tables. 4. Tickers. This board provides stock market updates and shows stock information like the stock code, price, number of shares, buying broker, sellings, or selling brokers. This is called the ticker. Number 5 is fundamental analysis. The analytical method of evaluating stock, and this is done by looking at financial statement, and news about the company. Number 6 is bull market, characterized by rising price. There is a prolonged period of increasing stock price. 7 is bear market, characterized by falling price. The stock market is downtrend. This is the opposite of full market, which is full market in number 6. Now is number 8. Initial public offering, or IPO. IPO process whereby a privately held corporation offers sells its shares of stock for the first time to the public in order to raise capital to fund a certain investment or business expansion. Now, number 8. Number 8 is dividend. Dividend is the share of profit of shareholders representing the earnings of company. Number 10 is technical analysis. Technical analysis, a form of market analysis that studies demand and supplies for securities based on trading volume and chart patterns. That's all from me. 10 things, important things to know about stock market terminologies. Thank you.
Alright everyone, that's conclude our presentation. That's all from us. Thank you for lending your ears. Stay safe and take care everyone.